All right, now we're talking about accounting for stock options. And it says in this particular problem that we want to, that Titania Company on January 1, 2018 granted stock options to officers and key employees for the purchase of 20,000 shares of the company's $10 par common stock. And it's going to, they have the right, the exercise price to buy at $25 per share. And they are exercisable within a 5-year period beginning January 1, 2020, by grantees still employed by the company. And they expire on December 31, 2024. The service period for this award is 2 years, and that is from January 1, 2018 through 18 and through 19. We assume that the fair value option pricing model determines the value of these to be $350,000. Now, on April 1, 2019, 2,000 shares, so that occurred on January 1, 2018. On April 1, we have 2,000 shares were terminated because employees resigned from the company. And when they resign, they lose their right to that. The market price of the market price of the common stock was $35 per share on this date. And then on March 31, the next year, a year later, 12,000 options were exercised when the market price of the common stock was $40 per share. So what it's asking us to do here is prepare journal entries to record the issuance of the stock options, a termination when that employee left, and the exercise of the stock options. So what we're going to do is we're going to set up, let's do it in blue, we'll say this is the Titania Company General Journal. And we'll put debits on the left just for grins, credits on the right, and the date over here. And we're going to record this in black, and it's January 1, 2018 when we do this first thing. We granted the stock options. So January 1, memo, we're going to record this memo on that day. And there's no actual journal entry, but we're going to say on that day, the company issued something wrong. To employees, we'll try a different color. It doesn't seem to matter. I wonder why. To buy, go back to black. To buy 20,000 shares of $10 par company stock at $25 per share. And that just gets recorded as a memo in the journal. Then at the end of the first year, we recognize that the value of these stock options is $350,000, and that they're going to give us service for this value of $350,000, and that's going to be over 2 years. So at the end of 2018, we're going to say December 31, 2018, we'll have compensation expense and compensation expense reduces net income, reduces shareholders' equity, and that's going to be for half of the one half of the 350,000, or 175,000. And we're going to credit paid-in capital. And you say, well, they didn't pay anything in. Well, they gave sweat equity, stock options, 175,000. So they did contribute something to the company to issue, to record, not issue, to record the cost of stock options as compensation. Okay. Then on April 1, 2019, on that day, we had 2,000 shares that were terminated when the employees resigned from the company. So this was for 20,000 shares up here. And so now it's April 1, 2019. And 2,000 of those shares, in effect, we recorded an expense in 2018 because we expected those employees to stick around, but we actually overestimated that 175,000 of compensation expense. And we did that by saying, oh, okay, well, we're going to record 350,000 divided by 20,000 shares. And if we just cross off some zeros here, 35 divided by 2 is equal to 1750 per share, times 2,000 shares is going to be 35,000 divided by 2, because we didn't record all 1750 as an expense. We only recorded half of that. That's this half. Divided by 2 is equal to 17,500 over recorded expense in 2018. And since we over-recorded it, it was not an error because we didn't know those people were going to leave. We're going to credit compensation expense in 2018 for 17,500 and debit paid-in capital. Stock options. Now, if we should have known that those people were retiring or leaving the firm, say, for example, they had written we find out that they had resigned, but we didn't record it until 2019, but they had resigned in 2018, then this would be wrong as a credit to compensation expense in 2019. It would have to be credited to retained earnings, and that would be a restatement, and we would probably get sued. Okay, now it is now March 31, 2020. So at this time, we are going to get cash, and I'll do this in blue for now. I like to go back and forth and mess you up. 12,000 shares at the exercise price of $25 per share. That means we're going to get $300,000 is going to be our debit for cash. We're going to have a reduction in paid-in capital. Remember, the paid-in capital is recorded at $17.50, and we do that for 12,000 shares. So paid-in capital for stock options is now going to be reduced because it's no longer stock options, it's actually stock, and it's going to be reduced by this $17.50 per share times 12,000. And when I do that, I come up with 210,000. Now we're giving them common stock at par, which is $10 par times 12,000 times the $10 par, or 120,000. And then we have the additional paid-in capital common stock, which is going to be the excess 510,000 minus 120. 510 minus 20 is 490, minus another 100,000 is 390,000. To issue common stock at exercise of options. And there you have it.